Greetings. We are going to be going ahead through these blended medium lectures, more on C corporations. During class, I promised to talk about stock options at some point. Reason being, stock options are a very important part of compensation planning, and compensation planning is part of the process of dealing with business entities and their owners. Oftentimes, it's a part of the planning for business entities and their key employees, not necessarily owners. So stock options have a specific and particularly good rapport with dealing with key employees because they are used as an incentive to keep key employees on the job. In fact, the idea of a stock option is basically it acts like this is the expression used in the business world, they can act like a golden handcuff. If you don't know what that is, think of the police forcibly wanting to hold somebody from being able to move their hands. Well, the police use handcuffs, but if the handcuffs happen to be golden, then the person whose hands are being metaphorically held is happy. And a key employee whose hands are being held to give them an incentive to continue to work in the employer's business, if the incentive to work in the employer's business for a long period, for many years, and of course the way to do that is to offer them something of value. That's always the key. And stock options are a great way to do that. So let's talk about what stock options mean from a tax standpoint. The slides do a number of explaining the book tax difference between stock options. I'm not interested so much in the book difference, the accounting under generally accepted accounting principles. That's not what this class is about. I'm more interested in the tax element. I'm also interested in the fact of teaching you how stock options are used. Again, now you see that they are a golden handcuff. So let's see why they are. Let's hold off on the tax area for a minute and let's see what is it about stock options that make them valuable from the standpoint of planning for a business. So this is what they do. The stock option does the following. It says to an employee, here's what we're going to do. We're going to give you an option, and that option is that you can buy our stock at a bargain price for, and normally, and this is just, doesn't have to be this way, but we're going to give you a stock option to buy, stock to buy, and the stock, of course, is the company's stock to buy at a bargain price, and we'll keep that option open for 10 years. So anytime during that 10-year period, the employee can buy the stock at this initial bargain price, and the stock, of course, during that 10-year period could go up and up and up, making the bargain purchase even greater. So the employee now says, well, if I have been given these stock options and I'm told that the options have forfeiture rights, this is language we're using now and learning for purposes of understanding how this arena of business planning works. The stock options have forfeiture rights, and the basic forfeiture right, it's not really a right, but they have forfeiture rights is what it's called, and the basic forfeiture is if you are no longer employed, the stock options expire. So now that's the golden handcuff. The golden handcuff is these stock options, they have value. There is a value to them, and I've been granted these options, and if I leave, I lose these options. That's not a great idea. That's not good planning for the employee. So the employee has an incentive. They're not required, but they have an incentive to stay. They're not bound like handcuffs handle a criminal where they can't move, they can move, but they would lose the value of these stock options if they were moved. And so that's why they act as golden handcuffs, because the employee has an incentive to stay on. There's another incentive that comes along with this, and here's where we get to the tax aspect. Stock options come in two varieties: incentive stock options, and these are qualified, and incentive stock options, which you can guess are non-qualified. So we'll just say non-Q, non-qualified. They have a difference for tax purposes. And they have a difference for tax purposes not only to the individual receiving the stock option, but for the business entity itself in an important way. So let's see what that is. The incentive stock options are not taxed when exercised. Let's go back for a second. No options, when given, are taxed. And that's another key. No options are taxed when granted, I should say. That's a real good part of the planning. That means that from an employee standpoint, you give me options, there's no tax when I get them. When you exercise the options, if it's an incentive stock option qualified, so this is the Q, no tax on exercise. And that's great. That means you can buy the stock if you can afford to do it at the bargain price. You can buy the stock, really own the company, and now not have to pay tax until you sell. Only when you sell. Cool. The incentive stock options that are NQ, non-qualified, as you can imagine now, they are taxed when exercised. Exercise means, so that we understand what's going on, is when you buy. The stock options give you a right to buy. The exercise means you buy. Options are a right to buy. That's what it means. It's an option. You can buy at the bargain price. When you do buy, that's called exercising it. Just to clarify the language here. Exercise means buying it at the bargain price. And you have to pay money for it. So the options, when granted, are great. You don't pay tax upon receiving the option. You don't have to buy the stock right then. You have the bargain price built into the option. When you go to buy it, within the 10-year period, you only pay the bargain price. Even if the stock went up multiple times or many, many, many times in value, you only pay the not the qualified, but the option grant price, that bargain price. So you don't have to buy the stock right away. The options have value when granted, and that value never goes away as long as you stay in the employee and you exercise them before the end of the 10-year period. The value doesn't go away. So if the stock goes up in value, way, way up, you'll exercise, you'll use the options to buy the stock. And the good point is, since you don't have to do that right away, if you don't have the money, you can just hold on to the option. You can get the money later. You can borrow the money if it makes sense. You can find out a way to do it when it makes sense to exercise the options. And if the price goes down, then you don't exercise. If the price goes down from the option bargain price and it's no longer a bargain, you just don't buy it. And also with incentive stock options, what happens many, many times is that during the 10-year period, or prior to the end of the 10-year period, the company is sold. Let me do that a little bit better. The company gets sold, and you know it's happening because you're the key employee, so you exercise right before the sale, and you use the sale price to help buy the stock. Because if you exercise before the sale, when there's a sale, you're going to receive cash for the sale. And so the money to do the exercise comes from the sale. That's what's known as a cashless exercise of buying an incentive stock option. The reason why they call it cashless is because you never need to come out of your pocket with cash. The cash comes from the sale. All right, so that's in a nutshell the real nice advantages of incentive stock options. And we see that with the incentive stock option that's qualified, we see down here, no tax on exercise, only sale. And the incentive stock option that's non-qualified is taxed upon exercise. Now let's get a little bit more refined about this part of it. Let's go into a little bit more detail, and then we'll have finished up the incentive stock options area. So in order to do that, what we're going to do is take a break, and I'll come back and we'll discuss the tax aspects one step further and wrap up stock options.